If your income changes every month, choosing the right credit card matters more than most people realize. For a lot of people, credit cards are treated like rewards tools, points, cashback, sign-up bonuses. But when your income isn't predictable, credit cards behave very differently. And the wrong card can quietly create stress, even if your credit score looks good on paper. In this video, we're talking about what actually makes a credit card work well when your income changes month to month. What to prioritize, what to avoid, and how to think about credit cards when your paychecks don't follow a straight line. This isn't about hacking the system, it's about stability. Most credit card advice assumes a few things. It assumes you get paid on a schedule, it assumes your spending is consistent, and it assumes you can predict what next month will look like. If your income fluctuates, those assumptions break down pretty quickly. A card that works perfectly for someone with a steady paycheck can quietly cause problems when income isn't consistent. Not because you're irresponsible, but because the system wasn't built with variability in mind. That's why a lot of people with irregular income feel like they're doing everything right and still feel behind. When income changes month to month, the goal isn't to optimize rewards. The goal is to reduce friction, to reduce surprises, to reduce stress, and to give yourself room to adjust. That starts with flexibility. Flexibility in payment timing, flexibility in how balances are managed, and flexibility in how issuers respond when your spending doesn't look the same every single month. You want credit cards that can handle real life, not ideal life. The goal isn't perfection, it's resilience. Instead of naming specific credit cards, it's more helpful to think in categories, because the category tells you how the card behaves under pressure. The first category is low pressure, everyday cards. These are usually cards with no annual fee, simple cashback, and fewer rules attached. They don't demand high spending. They don't punish you for taking a slower month. And they're easier to manage when income dips unexpectedly. These cards give you breathing room. They're especially useful when you're coming off a slow month and want stability more than upside. The next category is cards with more flexible statement behavior. Some issuers are more forgiving than others when balances fluctuate. They don't immediately react to short-term changes in utilization. They don't aggressively adjust limits just because one month looks different. This matters more than most people realize. If your balance goes up during a slower income period and then comes back down during a good month, you want a card that can tolerate that rhythm, because that rhythm is normal when income isn't fixed. The third category is simple cashback cards. Cashback is often easier than points when income varies. There's less pressure to hit specific spending thresholds, less planning required, and less temptation to overspend just to justify a reward. Cashback adapts to your life instead of forcing you to adapt to the card. Now let's talk about cards that don't always work well with irregular income. Be cautious with cards that require high monthly spending. Cards with large annual fees that only make sense if you spend consistently. Or cards that heavily encourage chasing bonuses with tight timelines. Those cards assume predictability. They assume your income will cooperate. And for many people, that's just not realistic. The issue isn't that those cards are bad. It's that they're unforgiving. And when income fluctuates, forgiveness matters. For irregular income, credit cards work best when you treat them as tools, not extensions of income, and not safety nets. They're tools for smoothing cash flow, for protecting your credit history, and for giving you optionality. In good months, you pay balances down aggressively. You lower utilization. You rebuild margin. In slower months, you stay conservative. You avoid pushing limits. You focus on essentials. This back and forth isn't failure. It's strategy. Stability doesn't come from perfect months. It comes from systems that can absorb variation without breaking. That's the difference between stressful credit use and sustainable credit use. The best credit card for irregular income isn't the one with the biggest bonus. It's the one that stays predictable when your income isn't. It's the card that doesn't punish you for having a real-world income pattern. If your income changes month to month, traditional credit advice often falls short because it assumes consistency that a lot of people simply don't have. I'm creating a flexible money system that explains how to manage credit and cash flow when income isn't predictable. Thanks for watching, and welcome to the Irregular Income Economy.